Hello, everyone. I'm Bill Squadron, President of Our Energy Policy, and thank you for joining us for today's webinar on the events in Europe and how they're affecting our U.S. and global energy markets. Certainly more evidence that however much we may want to try to predict the future, things happen that are unpredictable and we need to react and understand their impact. And we have a phenomenal panel here today to discuss it. I do want to call all of your attention to the opportunity to ask questions toward the end of the hour. There's a tab on the dashboard, and if you type in your questions, we will get to as many as we possibly can before our time is up. I also want to thank all of our partners, without whose support we couldn't possibly bring this series to you. So a very heartfelt thanks to our partners, and they support our overall mission of bringing diverse voices together to engage in civil and substantive discussion on the serious issues of the day, and then to communicate as a resource that dialogue to policymakers, the media, and others who are working so hard to try to advance our energy policy. Special thanks to Citi as our co-host for today. And I do want to point out that the support we have for our nonpartisan mission as OEP is particularly underscored today because one of our distinguished panelists is OEP's chairman, Yossi Hollander, who, like other panelists, will be expressing his own views because OEP, as all of you know, is completely nonpartisan and does not take advocacy positions, but we are delighted to have Yossi and our other panelists here today. So I'm now going to turn it over to our moderator, Ed Morse. Ed has a remarkable career, which I will only quickly summarize. He's currently the global head of commodities research for the strategy team at Citi. He has been a Deputy Assistant Secretary of State for Energy Policy. He's taught at Princeton, at Johns Hopkins. He has been a senior fellow on the Council on Foreign Relations. He's been an executive at Phillips. He has a remarkable career, and we're delighted to have him moderating this panel. So Ed, let me turn it over to you and our panelists, and once again to all of you, thank you for joining us.
Thanks very much, and it's a privilege to co-host this along with OEP itself. And I'm delighted to introduce our panelists on this discussion of Russia, Ukraine, and U.S. energy markets. We have with us Dean Foreman, who is the chief economist at the American Petroleum Institute, where he's been for a couple of decades and where he has been providing distinguished forecasting and market analyses that have been of use to those of us who are not members of the API for a very long time. Also with us, as Bill mentioned, is Yossi Hollander, who is the co-founder and chairman of Fuel Freedom Foundation. He is what he calls himself a technology serial engineer, and he's now also a philanthropist. And while he's chair of Our Energy Policy and his board, he is also the co-founder and chair of the Fuel Freedom Foundation, which is a non-for-profit organization whose mission is to actually strive for affordability in driving and in using energy, and doing that by opening markets up to competition, and particularly, which will be a subject of our discussion today, to cleaner American-made fuels, which will certainly be part of our discussion more broadly on energy security, not only for the U.S. but for the world as we have our discussion this noontime. And finally, Brenda Schaffer, who I have known longer than I've known anyone else on this group. I've been working with her on a series of things over more than a decade, including where she has been one of the world's leading specialists on energy in the Caspian. And she has been writing on subjects related to today's conversation at the Foundation for Defense of Democracies, a Washington-based think tank, where probably there's more work done on sanctions and their uses and abuses than any other place on the planet. Anyway, welcome to this, and we look forward to the questions that you'll be asking us. And meanwhile, I want to note that it's natural to start this question with the announcement from the White House yesterday of several things, including an announcement of a release of strategic oil from the Strategic Petroleum Reserve at a level of 1 million barrels a day. In the history of the SPR, there's never been more than 700,000 barrels a day released, let alone 1 million, even though it was set up to release 4.4 million a day for a short period of time. And it's going to be the longest release in history, stretching out from May to toward the end of the year, which will have a significant impact on various things. So, Dean, starting with you, was this a good idea and good use of resources? What are its pros and cons?
Whether it's a good idea, we need to see what we know and what we don't know, I guess is the way to put it. If the administration knows something about prospective developments that requires such a large, unprecedented, and preemptive release, then maybe it'll prove to be a smart idea. But a couple of caveats, I guess, that come with it. First, this could be a 30% drawdown in our reserves. And historically, at least, there's no statistical evidence that SPR releases have had any sustainable impact in lowering crude oil or motor fuel prices. So that's point one. The other is it really casts doubt on the official forecast. So the U.S. Energy Administration has been projecting for some time that the market could shift to a surplus as soon as this quarter. So obviously, if the administration believed that, they wouldn't have to release this crude oil. We'll see, but it really potentially throws national security for the U.S. because these reserves are meant to protect for discontinuity of supply. Again, we don't know what they know. If there's something about market developments that requires this, that's one thing. It's their call to make. But if it really is playing politics to just calm fuel prices in advance of midterm elections, then this is a potentially huge error.
Yes, do you have anything to add from your perspective? You're on mute.
I just don't know if I don't know if it is politics or not. Of course, the timing is interesting because it ends after the November election. But I think in general, it will have very little impact. I think long term, statistically, you could have much more impact if, in terms of expectations, if you did other steps.
And Brenda, anything to add?
I think we just have to recall that the real function of the Strategic Petroleum Reserve, and that's national security, that's energy security, and it shouldn't be used as a tool for price influence, but rather, especially when we're at this very precarious time in international security, I think there's some risks in using it in this manner, just basically for price influence.
Yeah, I would just note that when the White House gave its rationale for this, the rationale was concerns about the world losing maybe 2 or 3 million barrels a day of Russian supply. It's a hypothesis. Some people think it's real. Some people question it, but it certainly is a hypothesis. But it also leads into some other questions about energy security. We had yesterday not only the announcement from the White House, but we had the monthly OPEC Plus meeting. And the monthly OPEC Plus meeting had two noteworthy aspects to it. One is that the group decided, as they had last July, when they started to put 400,000 barrels a day nominally into the market, that now they were going to add, with a change in the benchmarking number for a number of countries, including Russia, Saudi Arabia, the UAE, Kuwait. So they're adding like 433,000 barrels a day nominally to the market. That happens at a time when tanker tracking is indicating that Russian exports are down by somewhere between 500 and 900,000 barrels a day, maybe not the 2 or 3 million a day. So we have OPEC Plus adding but really subtracting as a group from the supply in the market. So on that, and then Brenda, I'd like to start with you because you've written a lot on this subject. What is the problem in terms of these countries with the available surplus capacity in the world, Saudi Arabia and the UAE, strikingly so? Why have they not put more oil in the market to calm markets down? And what does this have to do with U.S. energy policy?
Right. So, I mean, definitely, sort of the quickest, easiest answer to address, any loss of Russian supplies would be to turn to Saudi Arabia and to UAE, which, relatively have a quick ability to rev up production. But they've made a really strategic decision that as long as the United States isn't interested in their national security issues, which, most relevant to their national security, they're not really going to give a lifeline to the United States here. The specific issues are, one, sort of the looming Iran deal, which as Saudis and others in the region perceive, doesn't change or limit Iran's regional role, ability to intervene in these countries. And then second, where we already see this, where Iran's proxy, the Houthis are, on a regular basis attacking Saudi and UAE cities and energy infrastructure, and this has gone, with exception of, some kind of rhetoric, no real addressing by the United States. So just like the Ukraine crisis is a threat to Europe, Iran is a threat to Saudi Arabia, to UAE, to most of the Middle East, and they want their issue addressed if they're going to actually help out the U.S. in this crisis.
Any other observations from panelists?
I think this is a good reminder, the Ukraine crisis and everything that is happening, that oil prices are set up internationally by supply and demand of the global economy. And even if we produced all of our oil, okay, in the United States and never imported, which is good, by the way, to do, but I'm saying it never imported even a single barrel, will still be impacted by the world price.
And let's add that coming into this year, by the U.S. Energy Information Administration's estimates, this was a tight market to begin with a global deficit by their estimates of more than 3 million barrels per day as of December.
Yeah, I think that's a good starting point. The winter was an unusually tight winter, and it was unusually tight in part because the U.S. really, as the world's largest producer of liquids, saw its production dropping as a result of the pandemic and the lack of drilling from 13 million barrels a day to under 11 at one point, and is back, at least in terms of EIA data this week, at 11.7 million barrels a day, still 1.3 million shy of where it was producing in the winter of 2019-20. That's kind of a big factor in the market. And then there has been, people overestimated the lockdown from the Omicron variant of the COVID pandemic, so demand turned out to be higher than people thought. We also had this really strange situation this winter where we had natural gas prices spiking long before the Ukraine crisis began. And as a result of that, natural gas was actually significantly more expensive than diesel. And there was fuel switching to diesel, maybe at least 600,000, if not 1 million barrels a day. Even though diesel prices were high, they were not as high as natural gas. So even before the Ukraine crisis, the world was kind of running out of optionality in terms of choice of fuel. So just thinking about, pre the crisis and then adding what happened with the conflict, what lessons should we learn about dealing with optionality? How do we have public policy pursuing optionality to provide for reliability, redundancy in the global fuel mix? And we can go, back to the first order. Dean, if you want to start, that would be fine.
It's a big ask, right? Because there are so many things that relate to workforce, supply chain, industry financial issues, and policy headwinds. And there are discrete things the administration could be doing right now to try to remedy those physical things, the financial things, as well as send the right signals so that financial expectations and investment in the sector continue to be healthy. Access to resources, leasing, that sends a huge signal. Many members of API will tell you they need 3 to 5 years worth of being able to plan forward in terms of siting, permitting, planning out their infrastructure, the long-term service contracts. In many places, that's not happening right now. And not having a plan in place for this moratorium on federal drilling is one piece. resistance to infrastructure, pipeline infrastructure has been another. On one hand, the administration's out there saying we're doing everything we can to help consumers at the pump. On the other, it really has hedgerow by hedgerow been fighting the industry. So again, policy matters, signals matter. It affects the flow of investment. The glass half full version of this is that the investment has picked up markedly coming into this year. Between the third and fourth quarters last year, we saw it industry-wide improve by more than a third. But it's still well down from where it was at the same point in 2019. And Ed, you were mentioning the 1.3 million barrels per day down roughly on crude oil production. This is a much larger and amplified shift in the sense that in the first quarter of 2019, on net, the US was exporting 1 million barrels per day on net of total petroleum, crude and products. This quarter, we're importers to the tune of 1 million barrels per day. So that's, a 2% global market swing in and of itself. It really is night and day. That's resulted in lower inventories. This last week for EIA, our inventories for crude oil at the lowest point for the week since 2014. And now being with this import dependence, all of this is before Russia, Ukraine, upward pressure on prices. So historically, that's a recipe for upward pressure on prices. And we need to get production going, infrastructure going, and if we're going to help our allies around the world, trade going as well to make this happen.
Yossi?
So I think we need to look at, I don't like to talk about energy markets because there are actually few. There's not such a thing as an energy market. So if you look at the electricity market, we decided politically to eliminate two of them, coal as an optionality, coal and nuclear to a large extent. Because of politics. So the result of it is now we only have basically natural gas and some renewables that can never sustain the full 100% reliability. And we're not even close to getting there in terms of solutions in the technology. So first we need to reopen all the optionality in the electricity market, and also relating to that energy security. For example, Florida has one major natural gas pipeline. You hit that natural gas pipeline, in a week there wouldn't be electricity in Florida. Okay, that's it. Okay, I mean, we think about it only in Ukraine, Russia, etc. It's at our home court. Okay, because we rely on a very few drivers of our electricity market. The second is the transportation market, and you just mentioned some optionality that people are switching back to diesel in places where they can to switch from natural gas cars to diesel. But basically, it's very difficult to take your regular gasoline-powered car and change it right now. We know we have ethanol in the market, and it's very interesting to look at countries that allow more flexibility in terms of use of ethanol, and they're much less, by the way, owned by the oil companies like Shell in Brazil, okay? And they own a large portion of the market. And you can see that the effect on the consumer prices is much better than the United States because they allowed optionality. And the way to allow optionality and add ethanol, electric is different, but allow more ethanol in the market is by creating flex fuel cars, which we have in the United States, and we can make all of them. So that will add optionality. As to electric car, I mean, we're doing everything we can to make sure that it's slower. We think that subsidies are solving the problem now. We need to have a supply chain issues in the United States. It's completely different. The problem is supply chain of batteries, not subsidies to the consumers.
Brenda, anything you want to add to that?
Yeah, so I think if we're going to address this energy policy challenge, we really need to look at the origins, because it's very easy just to say, oh, this is Putin's energy price, Putin's energy crisis. If we focus on that, we're not really going to solve, the issues here. So first thing, let's recall that we had an electricity and natural gas crisis in Europe prior to the Russian invasion of Ukraine. And in fact, even in winter 2020, 2021, we had a preview. We had a simultaneous cold spell in Asia and Europe, and LNG cargoes were expensive and hard to find. And we saw a mini energy transition from natural gas to, as you said, to fuel oil, to diesel, to coal. So when the gas supplies weren't there or too expensive. We saw, especially in Northern Europe, going over to fuel oil. And so it was a small version of what we got a year later. And again, nobody addressed that issue. They should have seen what happened there and said, okay, this could happen again. We need to prepare for it. Some of the reasons that we don't prepare for it is that in the West, we've completely changed our approach to energy security. Energy security used to be a really high element of national security, as it should be. But if you look at, for instance, the last White House interim national security guidance, it doesn't mention at all the topic of energy security, which is a first. And 10 times it mentions the word energy, but in 7 out of 10 in the context of clean energy. So there's really no discussion of energy security, and in Europe as well. This past commission basically sees energy as a subset of climate policy, and sort of until this crisis didn't really engage in the energy security policies, which had been a big part of the EU and even of EU-US cooperation. Something that's actually kind of interesting because, again, we're sort of focusing on an oil crisis, but it really is just as much an electricity and natural gas crisis, and those ones are harder to fix, need more kind of government intervention and kind of interesting work. But it's actually because this electricity and natural gas crisis is hitting every market, it will leave the US, or at least for a year or two, with a manufacturing advantage, because energy is the biggest input into manufacturing. So if there's high gas and electricity prices in Asia, Europe, and the United States, but less so in the United States, it does sort of give some energy to the US manufacturing sector or competitiveness.
That's only true if the economy stays on track here, though. And to expound on Brenda's comment, it wasn't just a cold snap in Europe and Asia. It was under investment by Russia for 2 years in terms of their natural gas, which is at critically low inventory levels, plus underperformance of renewables across the United Kingdom and continental Europe. Together, that triumvirate of things really contributed to $30 per million BTU gas in Europe coming into this year. And now with Russia, Ukraine, we've seen it $40, $60 per million BTU. It's been a step change.
Maybe I want to add one more thing. Sorry, is that the energy department, our Department of Energy, was founded on the premise of energy security.
Yes, I'm quite familiar with it. I was familiar enough with it by being in the government when the Strategic Petroleum Reserve was created, and those of us who had to deal with it wondered how we were ever going to put oil in it because the markets look so tight. But I think Brenda's point is one worth looking at. I want to get to it because the U.S. really can be advantaged in a way that no other country in the world could be advantaged as a result of what's unfolding with our particularly rich endowment of natural gas and the fact that we'll have for a long time too much in terms of being able to export it so that we'll be in an exporting position to help the world. But just looking at what we've been looking at, we know that there are people, including Tom Friedman recently in an op-ed piece in the Times, who was arguing that now is the time to double down on renewables rather than to go back to fossil fuels. So I want to raise two questions, and they're complicated and they need thorough examination to answer them. One is doubling down the right answer on renewables at this moment in time when we've just had the ultimate failure of wind and of hydropower in Europe and in China, where there wasn't the resilience and redundancy needed from fossil fuels? Or is now the time to actually have a rational debate about the road to cleaner energy and the role of fossil fuels in that energy transition? So two related but complicated questions, and Brenda, will start with you for the first time and then go to the others.
Okay, yeah, so I think it's really important that we remove this binary from the rhetoric of renewable versus fossil fuels, because the current generation of fossil fuels, and this you rarely hear from policymakers on either side of the Atlantic, the current generation of fossil fuels has to work with the base load of renewables, works with the base load of generally fossil fuels. So it's not like you can have renewables and not be using natural gas and have that base load running. And when they talk about cost, they don't talk about the price for that base load. They don't, they don't plan for, in many markets, don't plan for that base load. And again, if you talk about this, it's either, well, if you up renewables, you need less, less natural gas or other fossil fuels. It's generally not the case. You're still going to need a minimum of that base load to have the power, power supply. So I think we need to change some of that rhetoric of, is it renewables versus fossil fuels? And second, I hope the US and to a certain extent Europe will give a new look at treating natural gas differently than the other fossil fuels, because clearly with impact on environment, climate, oil and coal are a completely different category than natural gas. And somehow, just because we have this, some groups have a adamant opposition to all fossil fuels, they've really thrown away something that can, at minimum, lower air pollution in many places. It has a lower climate impact. And again, if you need to be realistic. Like we said, when we had a crisis when there wasn't enough natural gas, our power producers went over to fuel oil and coal. They couldn't go over to renewables. It's not like if you deprive the market of gas, suddenly it'll figure out a way to have more renewables, right? So if you deprive a market of natural gas, you're going to see this switching. We don't want the energy transition going from natural gas to coal and oil instead of natural gas to renewables.
Dean?
I thought Friedman's response was very disappointing. The world is not flat, to quote his book, right? And it's energy systems that keep it interconnected in an important way here. And anyone who really understands just the sheer magnitude of these systems, the embedded capital, the cost effectiveness, the energy density, all of the facets of this, I think we accept the climate imperative. We accept that an energy transition is inevitable and in process. The technology is evolving, but we've got to be realistic, as Brenda was saying, and pragmatic about the time scale over which this change can occur, and really look forward toward pragmatic policies that aren't just US-centric thinking by Tom Friedman. We have to think of the fact that we have a massive problem with global energy poverty, the fact that these systems are intertwined, our transportation systems are intertwined, secondary markets of vehicles are intertwined from Latin America to Africa, emerging nations across the globe. So really thinking more holistically is really critical in terms of the policies that are going to back this up.
I may want to add, you focus a little bit more on the electricity market. If you look at the transportation market, people have high hopes for the electric car, but they don't realize the scale that is needed to change and what are the best case scenarios. So under all estimates, the best case scenario is that by 2050, only a third of the car in the world will be electric, okay? And that's under optimistic assumptions. And the number of vehicles on the road will be double what it is today. The vehicles, the internal combustion engines on the road will be double what it is today. So that's at the phenomenal growth rate of electric cars. Okay, so maybe in the United States we'll have a higher percentage than the rest of the world, but we're looking at the global market. We're looking at a market where there'll be more demand for oil, even as the fastest growing segment of the transportation market is electric vehicles.
It's opening up to a debatable subject. I'm sure some people are going to chime in and talk about the inevitability of peak demand, but we can hold that debate when we have the question coming in from outside. What should we be thinking about in terms of the fundamentals for U.S. energy security and U.S. energy markets? And to what degree is what's happened pre the Ukraine crisis and during it to shape our views on what the elements of energy security should be in terms of U.S. policy? Yassi, you want to start with you on that?
So I think first of all, as you say, that realizing, as we said in the beginning, that energy security is a global problem and we need to treat it, and there's a lot of unexpected. That's why we have a strategic petroleum reserve and other resources. But if you're looking at a different market, I would open more for drilling. I mean, you can still have regulation that maybe makes it a little bit more expensive, but you need to open the pipes, you need to open the drilling, and more importantly, I think you need to open financing. And right now it is much harder. All the money is available. It's not available necessarily at the cost. Okay, so there's private equity money, but it's not as cheap as bank money. Okay, so and access to it is not very easy to a lot of highly leveraged producers. And that's the United States. But on a worldwide basis, if you're in Africa today, you don't have money to maintain existing oil and gas platforms. Okay, I expect production from Africa to decline, not to rise. Okay, like Nigeria, etc., over the next 10 years, if the current financing environment remains. So I think we have to avoid non-government policies, like, for example, there's a consortium led by Larry Fink that said that basically manages $70 trillion of investment and declared a war on fossil fuels, which may be something they can do in 30 years, but the technology is not there today to do it. So by drying out financing around the world, they're actually creating more damage, especially for the poor. So I think we need to put money, if you want to put money in climate, put it on research for new technologies that will be more economically effective. And in the meantime, we need to make sure we have enough energy for world growth, because it's very easy to cross the chasm and have a worldwide recession with many more millions suffering from it in the third world already today. Okay. So I think one, more production, second, more regulation that allows competition in the United States and opening the financial market. Speaking of regulation like that, for example, could be that allow an agreement with the car manufacturers that they'll produce all cars flex fuel. That's optionality in the market. Everybody will invest in all options. I mean, currently you look at all companies, they're diversified. They're investing in everything that is in the market. Okay, so they're not. they'll move to natural gas, and if tomorrow ethane will have a new market for more chemical, you'll see more investment in there. People are looking where they can make money.
Fair enough, Dean. When you look at this question, and you mentioned liquidity and investable capital before, I would like to note before turning to you on the question of how to enhance more liquidity in the market for greater optionality and more diversified investments, that in 2019, there was, in terms of green bonds, and I'm not talking about greenwashing, but sustainability bonds, there was about $250 billion of issuance. In 2020, there was about $500 billion of issuance. In 2021, there was $1 trillion of issuance. And during the period between like 2014 and last year, investable capital in finding and developing oil and gas went from a peak of $850 billion US dollars to, and this is all nominal, to around 400 billion, if not a little lower. So what can be done in terms of policy to create a better balance, for lack of a better word, to ensure the optionality that we've had as a theme running through our conversation this afternoon?
So there are a couple of things to unpack here. And the first is actually a snapshot back pre-COVID. You know, coming into 2020, at that point, there were many producers that were saying debt and equity markets were largely closed to them. And through the downturn and through the first 3 quarters of last year, the amount of debt on the balance sheet for the vast majority of producers, and the industry's kind of been caught in the crossfire here, because with the improvement in the price environment, they're being told, well, okay, you're out telling investors that it's about capital discipline and returning value to shareholders, what have you. When in fact, what we're actually seeing is that the vast majority of producers took on an extraordinary amount of debt that was over half of their balance sheet at that point, compared to historically having only about 1/3 of the balance sheet being debt. So if you get to 60% debt, nobody lends to you. It's almost existential. And magically, in the fourth quarter, as the price environment improved and became more constructive, we saw debt across every peer group that Bloomberg tracks get paid down. So being able to have the market fix this is one thing. On the international side, you hit a really important point in terms of the pace of international capital investment. Abacorp, the multilateral investment bank based in Saudi, they track 4- and 5-year investment plans across the sector, Middle East, North Africa, and have shown that it's a pool of capital that went down through the downturn. It's come back, but instead of having 42% of it going into oil and gas, only about 1/5 of it is now. So if you take a relatively fixed pool of capital and you spread it over many more proverbial mouths to feed, you're not going to be meeting, we can't have demand coming back at or above 2019 levels and expect to get something for nothing. The sheer amount of investment to continue to meet demand, to make an energy transition affordable is absolutely critical here. So government plays a role in the signals they're sending, its policies. Again, you can't curb access to resources and infrastructure and enable exports and expect the capital to flow. Bottlenecks anywhere in the system, the weakest link will break that. So cohesive, coherent policies, starting with resource access, not opposing pipeline infrastructure, supporting export infrastructure, normalizing trade and tariff relationships like we've seen in the past. Steel, Ukraine is the world's largest exporter of pig iron. Steel prices are going crazy since this. The supply chain issues, we mentioned the automotive sector. These have been vastly overestimated in how quickly they would clear up. They're protracted. There's no easy top-down market solution. So in the absence of a price in carbon, we're getting proprietary technologies in many cases getting advanced. We're getting people that are pushing and choosing winners and losers in the marketplace instead of letting the market sort it out. So if we can get policy neutrality with the right incentive compatible policies to make this investment flow, the market will solve many of these issues. But in the absence of a price in carbon, with a lot of market interventions, and in the US, the knee-jerk reaction to a lot of this has been everything from proposals for Nixon-style price controls to the administration itself in the fourth quarter last year having proposed to re-ban crude or natural gas exports, to higher taxes on the industry, to a clean energy power plan that would have all but eliminated natural gas in the power sector when natural gas was over 40% of it in 2020. Again, completely night and day just a couple of months later in where we are, but the policy actions still haven't made that shift to be compatible with the words that say they really want to help consumers.
So Brenda, just the last word on this, and we're going to open it up to audience questions right now after your comments. How do we find a way to bridge the divides in the U.S. that have prevented the kinds of more balanced policies that Dean has just looked at?
Thank you. So first we have to return energy security into being a component of national security. And in fact, any policy goal that the administration has, whether it's alleviating poverty, more equality in society, any kind of prosperity, you have to have the energy piece right, but it's certainly in their national security. So first thing, so some of the things we can do to improve the integration of energy security into national security. One, we need to look for foreign policy tools beyond the sanctions toolbox. We overuse them. Sanctions, energy sanctions become the goal and not the means. We rarely say, hey, are these sanctions going to modify Russia's behavior, Iran's behavior? We tend to look at, hey, we put more sanctions on, we increased, we caught this, we captured that, but rarely has it modified behavior. And I think we're in a sense, we have I would call it a reverse oil weapon. Instead of the producers denying energy to the markets, we're denying markets to the producers. But in a way, but we also pay a price for that, for that policy. So I think, one, we need to expand our toolbox, and national security has to have a lot wider tools than just energy sanctions or sanctions in general. Second, going back to, look at some of the successes that the US has led together with Europe, over the last decade, 2 decades. I think of, someone like Amos Hochstein, that's now the presidential advisor for energy security, you know, he played a huge historical role in shepherding the Southern gas corridor into Europe. This brought alternative new gas volumes into Europe. And if you see today in this crisis, you know, Italy, which has this pipeline gas, is doing better than other markets. We need that you have these same kind of people that played strategic role in the current administration. They should do it. And then also seeing, you know, we can't compartmentalize policy. You can't, let's say, as we discussed before, neglect Saudi Arabia and UAE's security needs and think that they're going to help you out on energy as if these things aren't connected.
Thanks very much. Kevin, it's now your chance. So we turn it over to you to see what questions people have for the panel.
Well, thank you very much, Ed, and thank you, of course, to all of our panelists. We do have a fair number of questions already lined up, but if anybody else would like to add one to the list, please go ahead and enter it in. First question here. Regarding optionality, it was said that power generators could not shift from gas to renewables. Do you see that dynamic changing with the massive offshore wind and solar build-out that is coming in the U.S. power markets based on interconnection queues and public policy?
Yeah, I'm going to just start an initial answer to that, and I know Yossi and others have views on it. If we go back a year and a few days, last March, we had in Texas the price of natural gas going to $880 per million BTUs. And just north of Texas in Oklahoma, it went to over $1,000. And that was because of a reliance on baseload of renewables, wind power, that was 20%. And there was no capability of keeping the propellers going in a freeze-off. And at the same time, no ability to keep gas flowing in a freeze-off. So I think globally, as we've all mentioned, I think before the Ukraine crisis started, we had a problem on the power grid as the world was going to renewables without looking at what the underlying baseload of storage would have to be in order to keep people having available power, let alone affordable power. But I turn it over to others to make comments too.
I think globally, if we look at Europe is actually showing the way. I mean, they have much higher percentage of renewable than we do, and in the electricity market, and that once they pass a certain threshold, the market stops functioning in reality, and they're actually scaling back right now. I think we'll see a much greater scaling back in Europe because I forecast a recession hitting Europe as a result of the huge energy prices. And I think the public will react to it. So the sentiment might change in that term. I don't think also there's a shortage of capital, as you pointed out before, in the renewable market. There's a shortage of capital in the base market, which is still the largest market. So as Dean said, just keeping whatever is functioning afloat, we don't have enough capital to do that.
I'd weigh in and add to that the cost level that goes with going, say, from 20 to 40% renewables on the grid to 50 to 70 to 80 to 100 is potentially exponentially different. And it depends on the amount of utility scale storage, the cost effectiveness of doing that. But look, it's moving in that direction. We see renewables in terms of capacity additions, especially in the United States, continue to grow. They're growing globally. And that trend appears likely to endure. However, the cost effectiveness of getting to the extremes of 80 to 100%, we would need some step changes that would make that really an order of magnitude, even in the best case scenarios for battery costs coming down for storage, more expensive than using fossil fuels today. So again, cost effectiveness, more grid interconnections, having things that help the system be more resilient and include more of those renewables. But we've got to, whether it's bringing nuclear back, having coal continue to play a role, natural gas playing an important role. But again, having the production, the infrastructure, all of that tied together in a cohesive policy.
Excellent. Ed, you actually mentioned baseload energy, and it's come up a few times in the conversation. We have a question here kind of addressing With natural gas pipeline vulnerabilities, sporadic local public opposition to fracking, and the sustained shift to electric vehicles, how likely is it that we'll be able to maintain a secure baseload without nuclear?
Is the question related to the US or is it related to the world?
Let's say US. I'm sure it, of course, has global implications.
I think all of us have talked about an all of the above policy guideline for this, so long as it's not going to be a policy guideline that's going to assure that methane emissions are going to grow and carbon emissions are going to grow. So I think within those parameters, there has to be recognition of a need for getting the world to be on a cleaner base, and the more diverse, the better. There happens to be, at the moment, a revival in interest by the investor community in nuclear, small-scale nuclear fission, and small-scale fusion, where, yes, you know, in 1960s, people said the breakthrough was going to be 10 to 20 years away, and people may still be saying the breakthrough is 10 to 20 years away. But actually, it's come a lot closer in the last year in terms of getting to the point where on the fusion side, you're actually creating more energy than you're using to put in. But small scale fusion and fission are there. They don't have the same problems necessarily as large scale nuclear power does, and they can be quite helpful as long as we get over the public pressures to deny it.
If we're going to meet environmental goals, nuclear needs to play an important role in that energy mix. There's no question about that. And the things that government is really good about doing, its capabilities are to defer expenses, capital costs, which are one of the deterrents and obstacles to nuclear. The other is in terms of siting and permitting. The permits, at least in the United States, both to build and historically separately to operate nuclear plants. So that's another process that government can assist with. So if these things can be managed, given give or take US and global societal concerns about proliferation, safety, not in my backyard kinds of issues, nuclear again has a critical role to play in this. It's the one technology with zero carbon that's scalable for baseload, and it should play an important role.
If I may add, just that we have to be careful when we're looking. There's a third of the world which basically talks about switching from one type of energy to another. There's another 2/3 of the world that is energy poor and wants to grow to where we are, and there's no way they can grow with the proposals that are on the table right now.
I'd make a further comment on that, and that is very much related to the global situation today, where we're seeing emerging market currencies depreciating against the dollar and against other hard currencies. We're seeing significant inflation on the cost of food and the cost of fuel. And we're seeing capital outflows from emerging markets. So the burden on emerging market economies to get adequate, sustainable, supportable, affordable resources is a burden of the advanced economies. And somehow it will have to be part of that global energy security mix that we talked about, all of us talked about earlier today.
And following on that, this is a really critical point. We think of wind and solar in particular as local energy sources because wherever you are that the sun shines or the wind blows is where the energy is. But unless, especially in the United States, you're willing to support the development of the value chain from mining to manufacturing of these things, solar panels, wind turbines, all the way through the recycling of batteries and other things, through the entire life cycle and value chain of it. If you're not willing to support that, and it only means on the margin going to China and buying the solar panels and wind turbines, you buy it at one price today, but the macro developments that you just mentioned, the development of central bank-backed digital currencies that are likely, for the Bank for International Settlements to proliferate over the next 5-10 years, the US dollar's special status in the world can continue to evolve. So you buy it at one price today, unless you have the value chain at home, it could be a dramatically different price if it has to be repurchased 15 or 20 years from now.
Excellent. I would like to point out, since we had a number of comments come in as you were speaking. People are very, they would like to point out that there is a strong bipartisan support for maintaining the existing nuclear fleet and existing in R&D on nuclear. So there does seem to be some hope around that issue. Moving on, we had talked a lot about national security in the conversation, and several people have pointed out that climate change poses a national security threat in and of itself, especially as pointed out by the military. But in recent energy independence discussions, much of the conversation is focused on increasing fossil fuel production. What is the impact of increasing one national security threat to protect against another, and how do we find the right balance on those issues?
I guess I'll take that. So first thing, I think we really need to talk about energy security, not energy independence. There's no reason to cut ourselves off from the advantages of traded goods, and as long as it's done, if you have proper energy security, you can use them, you can trade energy, and it benefit for all sides. But sure, of course, we have to we need to hit all our goals in tandem. I mean, there's no way that we could say, okay, let's forget about national security or economic prosperity and just focus on climate. Or if we just say that, well, we're going to just focus on national security and price, and we're not going to care about climate and the environment, it's not acceptable to our populations, and it's not acceptable, in general. We need to craft policies that actually hit all the goals and stop thinking about it as this or that, but those two together. But I think also we need to have a more open debate environment, because if you even dare question, for instance, is this the generation of renewables that will bring us the climate future that we want, or the environmental future we want, or if you talk about the national security implications. For instance, if you look at, but sort of the rhetoric today among our policymakers is that, well, let's get off of oil and gas, and then we won't have any geopolitical problems. And it's probably exactly the opposite. We're going from a system where the U.S. is king, and can provide all the energy we need at an affordable basis for us and for our allies and for a lot of the globe, to a system where China controls most of the relevant materials, minerals, so even the fact that, like, kicking in the Defense Act in order to source these materials, which has gone with almost no public debate. Like, do we use something like this type of war type tool for something like sourcing minerals? Maybe we need to think about something where it's not either, meaning that we're not just reliant on oil and gas, but also we're not reliant on Chinese supply lines and minerals. But we need the open debate environment that we can look at things. And I would say, also in our previous discussion on developing world, we never question the environmental impact of wind, solar, and hydro. Okay, but go look at these things, and the land use, the scale of the land use, it's not sustainable, and very delicate environmental systems, like in the developing world, when you have, massive wind versus a very small natural gas pipeline, you're also putting an environmental burden, on many places around the world. But we need to be more open and be able to discuss these things pragmatically, not emotionally.
I'd just like to comment on one of the things Brenda said, which may have escaped unless you were following what's happened in the last day, and that is the government did yesterday, when it announced the points on the SPR, indicated it was invoking the Defense Procurement Act of 1950, a Cold War piece of legislation that enables the government to basically commit to buying rare earth minerals and battery minerals. They were all listed in the White House fact sheet. And I thought it was kind of also interesting, just as an observation, that they did not invoke that act with respect to pushing further production from the US side, although there was an implicit bargain that was mentioned in between the lines of the White House fact sheet, saying that while they are selling SPR oil at a high price now, they'd be willing to buy it back at a relatively high but lower price in the future as an incentive to getting a higher production coming out of the US shale play.
What I liked about the question is you've got this dichotomy between thinking about the risks to high energy prices and high price inflation in general to the economy that could derail the economy at a point when we've expended so many policy instruments and the ability to pull out of the next cycle is perhaps challenged with the indebtedness we've taken on, versus alternatively the risks to national security of having a potential disruption with the kind of geopolitical events that are playing out. Now, we don't know what the administration believes about what could happen with Russia in the next 6 months, and again, whether a preemptive positioning of strategic petroleum reserves in advance of that is what's necessary. But barring that, if this really is just trying to quell prices, I would say that their estimate was, by the way, that this could lower gasoline prices in the US by only 10 to 35 cents per gallon. That's a 2 to 8% savings for consumers over 6 months. Minuscule. And even that is questionable because if you look at historical releases, it's not clear that there's any enduring evidence. So we haven't had a release this large, but this says the administration believes the economic concerns outweigh the national security concerns. And if we don't have those reserves, I would say that the national security concerns take precedent and should be elevated.
I think a black and white answer is also bad. I mean, just drill, baby, drill, or no fossil fuels as answers to our complex world environment is so naive and so incorrect that this is a real becoming way more complex, and we're dependent on a lot of things internationally. Okay, instability in one country in Africa can stop the whole world battery production. Okay. At the same time, we're not allowing this country to have a normal electricity. Okay? So we have to think about those things are interconnected, okay? And we have to start thinking globally in terms of all goals and different solutions for the US market and for the global emerging market, which Ed talked about.
Thank you. Well, Ed, you did mention the question about peak demand for oil during our conversation. It's not exactly on peak demand, but as pointed out, that as we see improved fuel efficiency in our vehicles, increased adoption of EVs and hybrid technology, as well as a switch from natural gas to different methods of heating in our cities and inclusion of heat pumps. Question is, we're curious for panelists' thoughts about how these factors and factors I did not mention will impact the demand for oil in the near and long term.
Ed, this is you.
Okay, so I don't want to hog up all of the remaining 3 or 4 minutes, but first of all, the fact is that the efficiency of the U.S. fleet has not improved one iota in the last half decade at least. I don't know, Dean, you know the numbers better than I do, but there's not been any notable improvement, and one can argue why that's the case. What's not arguable is that for the last 75 years, the oil intensity of GDP has fallen around the world, and the rate of growth of which, or the rate of decline of that elasticity of demand, has been the same in emerging market countries as it is in Asian countries. So when you look at the history of this, and I started looking at it in the 1970s, when for every 1% increase in GDP in the world, there was about a 1.2% increase in oil demand. And that was true in Europe, it was true in Japan, it was true in the United States, where now it's a very, very low number. And even in China, where you go pre-2010, every 1% increase in GDP had more than a 1% increase in oil demand. And that has dramatically dropped, such that demand for gasoline and diesel flattened out in 2011 and hasn't grown very much at all since then. So I tend to think of this long-term trend in a different way than Yossi did. And I recognize that if you look at a doubling of the automotive fleet and an increased role, but not a dominant one, of electric vehicles, that you may come to a conclusion that we're in a demand super cycle again. But I think the historical experience would indicate that the incremental demand for oil is going to be in petrochemical feedstock and maybe jet fuel. And even jet fuel has a significant role that can be played of sustainable fuels, including fuels coming out of waste material. So I tend to be a quote optimist, close quote, on the subject of that reliance on fossil fuels.
I'd add the death of oil demand has been greatly exaggerated in the sense that in February, 21.6 million barrels per day in the US, the highest for the month since 2000, actually the highest for any month since August 2005. Globally, EIA has us at 100 million barrels per day, growing to 104, a world record at the end of 2023. If that proves to be right, and the elasticity they're using it's not inconsistent with where it's been recently. So if the economy stays on track, the demand globally is continuing to grow, and we need supply to go with that. And it's not drill, baby, drill per Yassi's comment, but it is just making sure that we've got, again, coherent energy systems that are equitable across all the nations that are trying to improve their quality of life, living, and human and economic development along the way.
Maybe one more comment. There's a big effect on when peak oil is going to come as to investment, because large oil companies are not investing in large projects if they think that peak oil is 10 years from now. If it's 30 years from now, that's a whole different question. So it has a huge impact on investment of large companies in large projects, which translate again into availability of oil in the short term. So it's not just a theoretical question, it's already impacting investment.
I hate to jump in here because this has been such a thoughtful and insightful dialogue, and we could obviously go on for quite some time, but unfortunately we're out of time. I do want to let everyone know that we will be posting the discussion on the Our Energy Policy website. So for those of you who have colleagues who wanted to attend and couldn't and really want to benefit from this discussion can find it on the site within the next 24 hours. Also on our website, those of you who are interested in additional reports, studies, papers, and so forth on this topic, the Our Energy Library is a resource that you should certainly feel free to use as much as you would like to support your work and for your own interest. I want to thank our supporters once again, all of our partners, in particular our co-host Citi today. Thank all of you in the audience for taking the time to join us. And of course, particularly thank our extremely distinguished panel, Brenda, Dean, Yossi, and Ed, for this stimulating conversation. So thanks again to everyone, and we look forward to seeing you at a future event, and everyone have a good weekend. Thanks a lot.
Thank you.
Thank you, everyone.